Imagine being able to own a small piece of your favorite company, whether it's a tech giant making smartphones, a car manufacturer, or an online retailer. That's exactly what the stock market lets you do. By buying shares, you become a part owner, no matter how small your stake. This simple idea is at the heart of how the stock market works and why it's so exciting for millions of people around the world. Let's dive in and see how this marketplace operates and why it matters to both companies and investors. Share is more than just a piece of paper or a number on a screen. It represents a tiny slice of ownership in a company. When you own a share, you actually own a part of that business. This means you get to benefit if the company does well, and you also share in the risks if things don't go as planned. Shares are the basic building blocks of the stock market, connecting everyday people to the world's biggest companies. Companies often need money to grow, launch new products, or expand into new markets. Instead of borrowing a huge sum from a bank, they can sell shares to the public. This process is called an IPO, or initial public offering. By selling shares, companies raise the funds they need, and in return, investors get a chance to own a piece of the business and potentially benefit from its future success. IPO, or initial public offering, is when a company offers its shares to the public for the first time. This is a major milestone for any business. It means the company is ready to invite investors to join its journey. After the IPO, anyone can buy and sell these shares on the stock market, making ownership accessible to a wide range of people. Once a company's shares are available to the public, investors can buy them through the stock market. This process is straightforward. You place an order through a broker or an online platform, and if someone is willing to sell at your price, the transaction happens instantly. This system makes it easy for anyone to become a shareholder in companies they believe in. Let's look at a simple example. Suppose you buy one share of a company for 100. A few months later, the share price rises to rupee 150. If you decide to sell, you've made a profit of rupee 50. This is the basic idea behind investing in stocks: buy low, sell high, and pocket the difference. But remember, prices can go up and down, so profits are never guaranteed. Of course, things don't always go as planned. If the share price drops to rupee 80 and you sell, you lose rupee 20. This is the risk every investor faces. The stock market can be unpredictable and prices can move in both directions. That's why it's important to understand the risks before investing your money. Stock prices move because of supply and demand. If more people want to buy a share, the price goes up. If more people want to sell, the price goes down. This tug-of-war between buyers and sellers happens every day, influenced by news, company performance, and even global events. It's a dynamic system that keeps the market lively and ever-changing. Several factors can push stock prices up or down. Good company performance, strong profits, new products, or positive news can attract more buyers and drive prices higher. On the other hand, poor results, disappointing news, or industry troubles can lead to falling prices. Investors pay close attention to these signals to make smart decisions. Stock exchanges like the National Stock Exchange and Bombay Stock Exchange are the official marketplaces where shares are bought and sold. These exchanges provide a safe and regulated environment for transactions, making sure everything runs smoothly. They connect buyers and sellers from all over the country, making investing accessible to everyone. The stock market isn't just about buying and selling shares. It plays a crucial role in the economy. Companies use it to raise money for growth, while investors use it to build wealth over time. This win-win relationship helps drive innovation, create jobs, and support economic development. Investing in the stock market offers the potential for higher returns compared to traditional savings, but with greater rewards come greater risks. Prices can swing up and down, and there's always a chance of losing money. That's why it's important to balance your goals with your risk tolerance and never invest more than you can afford to lose. Successful investing isn't about luck, it's about patience, research, and a long-term mindset. Take time to learn about the companies you invest in, stay updated on market trends, and don't panic during short-term ups and downs. Over time, disciplined investors are more likely to see their wealth grow. When you buy shares, you're not just investing in a company, you're sharing in its journey. Whether the company launches a new product, expands to new markets, or weathers tough times, you're along for the ride. This connection makes investing more meaningful and rewarding. To sum it up, the stock market is a place where you can buy a piece of a company, share in its successes and challenges, and potentially grow your money over time. It's a dynamic world full of opportunities and risks, but with the right approach, it can be a powerful tool for building wealth and achieving your financial goals.